And we wanted to kind of evaluate whether Facebook is a buy at the moment. And we're recording this on November 17th. So just to paint the general picture, markets have tanked. And there's kind of like this general question right now. A lot of people are debating whether the market has bottomed out or not, whether it's a smart idea to start averaging into the market. And a few weeks ago, Altimeter, who is an investor in Facebook, wrote this letter, which was called "Time to Get Fit." Was a public letter to Mark Zuckerberg and the Meta board of directors, and basically it called for a refocus of the strategy, like away from the metaverse, and basically said you need to reduce your workforce and focus. And it seems like Facebook has done that now, has already laid off what was it, 11,000 people, so quite a big reduction in workforce, around, let's say, 9%. And
Yeah.
so and the market has responded relatively positively to this change. But I'd love you to just show us how to think about stock analysis, and how you would sort of evaluate Facebook or Meta at the moment.
Awesome. So yeah, this cool. We're gonna do it like really simple today, George, just like for the sake of simplicity. But of course, this could be a really deep technical analysis. That's how it really works when like you're an institutional investor. But let's start. Let me share you. So first of all, we need to start with financial statements, which like these are basically like accounting documents. Financial statements are key for either investors, like market analysts, creditors, even like a retail small investor, because it allows us to understand how companies, in this case Meta's Facebook performance is going, right? Like numbers, financials tell us a story about how well or how bad a company is doing. And the important thing here is, George, is that financial statements and accounting and financial ratios, what we want is like the ability to compare a company and its current positions, its current performance to either the past, to similar competitors or similar companies, or even different companies, right? So we want to make like apples versus apples comparisons. That's really really important. So we have three key financial statements. We have first the balance sheet, which is basically like a photo, right? It's a picture of how in a current moment, or in a point in time, how a company's assets compare to its liabilities and its equity or capital.
Mhm.
So basically, it tells us, okay, what a company owns and from where that assets come, right? Like, okay, at the end, your total assets are equal to the liabilities plus your equity, right? So that helps us to understand, okay, how well positioned a company is, how much leverage it has, and a bunch of like financial ratios and financial information that allows us to understand how positioned is a company in a certain moment. The income statement is focuses primarily in like a company's revenues, like it's how sales are going, right, and the expenses that are directly related to sales, and others that are related to other variables. But at the end, what we want to see with the income statement is, okay, how much revenue that company is producing, and at the end, how much net income is that company having for a certain period. So if we compare the income statement, George, to a balance sheet, the balance sheet is like a snapshot, like a photo, and the income statement is more like a video of how revenue and expenses worked for a period of time for a certain company, right?
Correct. And the standard here is quarterly breakdown, right? So you can see
Yes,
how
yes,
the financial situation of a company evolved quarter, and then you have the net income, which is essentially revenue minus expenses.
that's perfect. So yeah, and finally we have the cash flow statement. So something really interesting, George, is that lots of like retail investors or people I have spoken with, like they always focus on, oh, this is a profitable company. Like they focus a lot on profit, And in reality, George, we know that there are certain companies that can be profitable, that they finish like a year with profit, but they could still face bankruptcy. And this is crazy, George, because it sounds like not logic, right? How could a company have a profit, like, net income, but at the end still face bankruptcy? That's related to cash flow. So let's remember that cash flow for a company is the same, it's just as blood circulating through a human body, right? If you stop the cash flow for a company, that will kill the company, because you need cash to pay all your expenses, like salaries. What allows you to keep going. So the cash flow statement basically says, okay, how is the free cash flow, or how is how good is a company to produce free cash flow, to generate real cash, to pay all its like obligations, and all these expenses, fund investments. So it's really really important, because if you get a company, let's say you get a company which is profitable, but it has a lot of clients or customers are still owing money to the company. So yeah, in theory, you could have, like a profit, but if you haven't been able to receive that cash, you could go bankrupt, right? So it's really really important to have a cash flow statement to understand how well a company is managing its cash, and if at the end it is having cash to pay everything that it must be paid, right?
Correct.
So
But generally, would you say that tech companies normally have that cash flow problem? I could imagine that it's normally more traditional businesses, that like maybe sell something and they're still waiting for payments to be made. Because I mean, these startups, these big tech companies, they normally sell like services or digital goods, advertisement, etc., where the cash flow seems to be immediate. So do these big tech companies also have this type of problem?
I don't think so. Like a really good example of this is Amazon. Amazon for several years they kept operating with losses, right? Like they didn't have a profit. They were so good generating cash, and that those cash flows gave like creditors or investors so much confidence about Amazon's ability to pay its liabilities, that like money, cash, kept flowing, right? So yeah, at the end, to be honest, I think it depends a lot in which company you're talking. But what we have seen for big tech, like really big tech, they are really good with generating or getting cash. So yeah, I don't
Correct.
think it's a problem with big tech. Yeah, and like you could talk about like the financial sector, like banks, like the way they are, like U.S. banks, for example, have a lot of support from the Federal Reserve, right? So yeah,
But
it's
banks might
really
have more
interesting.
problems in terms of cash flow,
Of
right?
course,
Because if someone defaults on
yes,
their credit or on their loan, etc., right?
that's right.
So mhm.
Yeah,
That's why
yeah, that's
banks have
that's
more exposure, have more risk exposure in general.
basically that's like any financial business, needs to be really really careful with that, because if you have like a bank run, basically that's what happened to FTX, right? Which is
Correct.
like such a hot topic right now. So yeah, they had a huge problem with the value of their collateral, and then everyone's scared, like all investors and clients were so worried about what's going to happen with FTX, that they started to take out their funds. So yeah, that's really serious for financial institutions. So continue with like other financial metrics. So we have ratios. So ratios basically allow us to compare companies like on a very simple apple to apples basis. So first we have like the book value, George, which is like it's usually based like on like an accounting valuation of a company. So it includes like equipment, buildings, land, or anything else that could be sold, and that value, it's basically what we use to divide the price of a stock to its book value, right? So generally what investors look at, the P2E ratio, is that the lower the P2E ratio, the safer it should be to invest in a company, right? It's generally what how it is used. Now, the really really famous price to earnings PE ratio is the one which is mostly used, and most investors refer to the PE ratio. Is the individual price of a stock So you divide the total market value of a company by the number of shares, outstanding shares. So you get this price per share, like, and then you divide that by the earnings per share. Or you could just divide the total market value of a company by its total earnings.
Okay.
So
Market value equals market cap, correct? Market capitalization.
yes,
Okay.
that's correct. So yeah, like if you want to like quickly get the market cap of a company, you just need to multiply the number of shares that company has by the like the lastest price, right? The latest market price, and yeah. So on a very simple way, George, the PE ratio allows you to see how many years it will take if you consider the earnings of a company to buy that stock. So if you have like a P of 10, that means that it will take you 10 years of earnings to buy the price of that share, right? Does
Mhm.
that make sense to you?
Yep.
So, of course, if you have a really, really high PE, a really high price to earnings ratio, let's say 30 or 50 or 100 times the price of the stock compared to its earnings, that's something that you should really be worried about, because it could mean that that stock, that company is highly, highly overvalued, right? And just imagine like a price to earnings ratio of 100 could mean like, okay, it will take me a hundred years to recover my investment. So yeah, it is really important to see it that way. And something really important, George, price to earnings is really useful, but it's not enough just to use the PE ratio. Let me give you just another quick example of
And just as
why.
a quick
Yeah,
side note, the only thing that can kind of offset that particular data point is the growth rate of the company, right? So if a company has a very
that's
very high
that's right.
growth rate, potentially the high PE ratio might be justified if the
Yes,
company is growing really really quickly, right? Because then investors
yes,
are just expecting that earnings are going to increase and that the price to earnings ratio is
that's
going to
right.
come down dramatically within the next few years.
And we're gonna see that's what happened with Facebook, because remember that the formula, it's market value divided by earnings. So some lots of times what happens, especially with with high growing startups or growth companies, is that the valuation, like the market value, is so much higher than the earnings, because investors see a potential. So the key word here is, okay, this company has a really, really high PE ratio. Is that because it's, like some speculation and there is a bubble, right? Like there's some sort of a bubble effect with this asset, this stock, or this reflects the company's high potential to start seeing really, really high earnings in the future. And if that's the case, we should see, if that's a successful company and that high earnings growth happens, okay, the PE ratio should like move closer and closer to, like, maybe the industry average,
Correct.
right?
And I think actually that's one of the reasons why I'm always concerned about the strategy of a company. Like when I think about
Yes.
like investment, I prefer to invest in and hold for like a few years. I'm not like a day trader or anything like that. I don't have time for that. So the uh, because ultimately you're always speculating, like you're always evaluating like the future growth potential of a company, which is why I think that yes, analyzing the financial statements is super important to understand the current position of the company, but I also think that you always need to evaluate the strategy, like where's the company heading over the next 5 years, over the next 10 years, so that you can have an idea of how earnings are going to continue to develop, right? Because
Yeah.
otherwise
Yeah.
I think that's always something really really important, that you need like a more holistic analysis. You can't it's in my opinion not sufficient to just look at a company's financials. Like you need to think about what is the company going to do over the next 5 years that is going to move the needle. Do you agree with that?
Totally. I mean, that's the tricky part, George. And to be honest, I think that's where the real value is when you are analyzing a company or a stock, because we know that past performance is not an indicator of like future performance. So yeah, financials help you to understand like a lot about that company, but at the end the future will be determined by how well that company keeps innovating, keeps like taking care of costs.